and this particular topic is how to get your net worth to $1 million, what I consider to be the fastest way. And it's really not difficult at all, and we'll go into this. So there's 5 specific categories that I use to go over $1 million pretty fast. Again, my net worth went over $1 million when I was 33. And these were the formulas that I used. So number 1 is, and it doesn't have to do, and also remember, 97% of the doctors that retire cannot retire at the same lifestyle. And then remember, exchanging your time for money, your job, you only have a 1% chance of becoming a millionaire if that's all you do. And quite frankly, when I learned that actually scared me enough, to pursue the venues of wealth and not just pay attention to making money by myself. So the 5 major categories, and we'll go into the hierarchy and the importance of them. The number 1 category you should always do first is buy your house. That's the number 1 thing you should do first. And the reason you should do that is it's a forced purchase. And the number 1 reason people don't become millionaires, like 80% of the population does not become millionaires, has nothing to do with the amount of money they make. It's pretty easy to become a millionaire over time. If you put 20, 30, or 40 years together, and you have an income of $50,000 or $70,000, it's pretty easy to accumulate a net worth of $1 million. It's pretty easy. And so the return on investment is never the issue. Everybody always talks about return on investment. And that's kind of important, but that's not the number 1 issue. The number 1 issue is lack of discipline. And so everything that I talk about is not return on investment. It focuses on the number 1 problem that inhibits wealth. And the number 1, naturally, and I'm talking about naturally, you'll naturally become wealthy if you do a few of these things that I'm getting ready to talk about, but it'll take 30 years, but you'll definitely be wealthy. So the number 1 reason is lack of discipline. That's the number 1 reason people don't get wealthy. And so I particularly pay a lot of attention into things that will counter lack of discipline. So it is not return on investment. It's lack of discipline. So having said that, the number 1 investment you should always there's 5 categories to get to $1 million fast. And the first one is to buy your house. So that's the very first one. And the number 1 reason is it overcomes lack of discipline. It makes you pay. It makes you pay into an asset. That's what it does. And it's the highest form of payment. It's the highest form of payment. It's called pain. So you'll pay. That's the first thing that you'll pay is your mortgage. So that's number 1. And that's the reason is, and it has other factors, leverage and all that stuff. But that leverage and return on investment are not the number 1 reasons people don't become wealthy. It's lack of discipline. So number 2 is your office. The very next thing you should purchase is your office, and it's for the exact same reason. It's called a forced purchase. It overcomes lack of discipline, your office. And once again, you have high leverage. You put X amount of money down, whether it's $10,000, $20,000, $30,000, and you control $100,000, $200,000, $300,000 piece of property. So it overcomes the number 1 reason for lack of wealth, discipline, and you get all the other components relative to real estate. And so remember, when we look at the components of real estate, remember it's leverage. The 6 major components are leverage, and this is why over 70% of the millionaires become millionaires in real estate. So you're looking at leverage. You can put a small amount down to control a large asset. Well, you can't do that with stocks or bonds. So the next one is equity. The next one is appreciation. The next one is depreciation. The next one is cash flow. The next one is the money that does come in cash flows in the form of capital gains. So those are the 6 categories that real estate offers that no other investment vehicle offers. Stocks don't do it. Bonds don't do it. T-bills. No, I mean, there's nothing else that offers what real estate offers. And it's what's called a primary pain-based purchase. It's shelter, where people are forced to pay it. It's the highest need there is, and it's a repetitive purchase. It's a monthly payment for a mortgage or rent. So, anyway, having said that, the number one is your house. Number two is your office. And, I'm seeing a lot of doctors they're spending a lot of money on rent, as much as $3,000, $4,000, $5,000 a month on rent. And that just astonishes me. And then when I hear the doctors have been paying that kind of money for 5, 10, or 15, or 20 years. Well, the person that got rich is the owner, not you. And that's called a huge missed opportunity, is what that's called. So you want to get into your office as fast as you can. And that's the reason why. You're going to have leverage again, and you're going to have a forced purchase. You're going to make that payment every month for your office. It overcomes discipline, and leverage overcomes discipline. So we're going to come back to that in just a second. So that's the second thing to do. That's because it's forced. That's why that's the second thing you should be doing before you do anything else. Now, the third thing to do is your retirement account. The retirement account, because it's 100% tax-free. Well, there's really two big reasons. Well, number one is if you use a certain type of retirement account, and there's different types of retirement accounts, it would be tax-free. So if you're in a 50% tax bracket with federal, state, city, county, you're already saving 50%. So that's the number one. Now, once again, what's the problem that people have by not having retirement accounts? Is it because they don't have the money? No, it's lack of discipline again. Discipline is always the vast majority of the reason why people don't become wealthy. So the other reason is you can use your retirement account to buy real estate. And when you do buy real estate out of your retirement account, the money that comes out that is spit off from that real estate is 100% tax-free. Now, that's not going to be as important to you in your 30s or your 40s. That's going to be unbelievably important to you when you're in your 60s and 70s and 80s. That's going to be very important. It represents a lot of money when that money comes back and it's not taxed. So your retirement account is the third place that you should be putting money. And I always recommend that it be maximized out. And I also recommend automatic withdrawal into your retirement account. And the reason for that is, again, discipline. People don't do retirement accounts because they just don't take the discipline. And I can't tell you how many people just go, well, I'll get around to that. And 6 months later, they didn't start a retirement account. 1 year later, they didn't start a retirement account. And so you have that much more money in taxes that you have to pay, and you have no asset growing for you. And now you don't even have the capital in a retirement account to buy an asset like real estate. It's like 0 for 0. So right now, if you're renting your home, you're renting your office, and you're not doing a retirement account, you're in the worst situation there is. And you gotta get out of that. So after the retirement account, the very next category is the associate doctor. That's the next step to wealth, and now we're starting to leverage time. And so we start to implement the associate doctor. And remember, all of these things are building for you. Every month, your house equity is getting bigger. Appreciation, all of that's getting bigger and bigger. Your office, if you own it, it's getting bigger and bigger. Your retirement account, it's getting bigger and bigger, especially when you leverage that retirement account in real estate. Now it's on steroids. Now you have an investment on steroids. And then the associate doctor. And remember how easy it is to bring on an associate doctor. We explained this in detail before, that the average associate doctor, if you pay him like $30,000 a flat fee salary, It's only like 13 visits at a $50 per visit. It's only like 13 visits a week. That's it. To break even, to where it doesn't cost you anything. 13 visits. So the system that we have, you're just like guaranteed to make money. They're going to see over 13 visits a week. The question is how much money. That's what, and of course now not only are you going to make money, but now you're going to do another thing with time. Now you're going to be able to take time off and vacation, and now you're going to do the number one thing that's going to stop you from being burnt out. And actually now you're going to start enjoying being a chiropractor, because now you're enjoying life. When you're always stuck in that office, you can't enjoy life, and that's what burns people out. Low productivity. So that helps in many ways. So that's the associate situation. And then the fifth thing is now buying real estate. And we talk about, residential real estate, that's rental property, and you keep it. And of course, we teach all of these. We teach all of how to do all of these things, how to do them effectively, efficiently, and not to do them through traditional means. What's traditional means? This means buying full price with a mortgage and a realtor. None of that. So those are the 5 categories that I used to become a millionaire at age 33. And every month, all of those were building wealth for me. My home was building wealth as I paid a mortgage. My office building wealth. My retirement account. And I learned the hard way with that. There's time periods where, that I didn't invest in that retirement account, and it was because of lack of discipline. That's why. Even if you don't fund it 100%, you can fund it 10%, you can fund it 5%, you can fund it 50%. I mean, every month there should always be a check going into that through automatic deposit into your retirement account. And that's building for you every month. So that all this is every month, all of these vehicles are building wealth for you. And then the associate doctor, same thing, every month, that's creating wealth. And then the next big step is to take the money from your retirement account and your associate doctor and now leverage that into real estate. And that is the 5 steps of how to get to $1 million, the safest and the fastest, where you have $1 million assets. Now, let me just take a minute and go into the 4 reasons why people stay broke. And remember, most Americans are living paycheck to paycheck. And the reason they stay broke is mainly because of 4 categories. It's not because of the money they make is low. That is not why. I mean, there's millionaires that go broke every day, and they're making $1 million. And because they make these same mistakes. And here's the 4 mistakes with capital and money that keep you broke or start creating wealth. Number 1, is it whatever it is, when you have your money, when you buy, whatever it is you're purchasing, is it tax deductible or taxable? That's number 1. How can whatever it is I buy, how can I make it tax deductible versus paying taxes on it? You're already going to pay 1.5 times more for whatever it is you bought, that extra 50% that you don't even see. And remember, that extra 50%, you had to make another 50% to cover the overhead for that tax money. I mean, this thing just is like a negative domino effect in the rearview mirror. And then the next category, when we talk about the 4 basic concepts of why people with average incomes don't become millionaires. Number 1 is they purchase taxable items. Number 1. Number 2, they purchase depreciating liabilities. So when they buy it, a month later, it's worth less than what it is when they bought it. That's the second reason you'll stay broke. No matter how much money you make, you'll stay broke with these types of purchase patterns. And the 4 purchase patterns I'm covering right now is the American way. This is how the vast majority of Americans buy. This is how the vast majority of Americans have been imprinted. Wealth is not taught in public schools. How to stay broke, get a job, and do all these 4 things is why you stay broke. That's what's taught. Now, so the first one is it a tax deductible expense that you're buying, or can you make it tax deductible? Number two, is it a liability or is it an asset? Well, people keep buying liabilities. Number three, is it depreciating? Is it getting lower in value over time as opposed to increasing value? That's the next, and you can look at everything you buy, and they fit into these categories to various degrees. And then the last one is the killer. The fourth one is it's a monthly payment, and that's called a credit card. That's called a credit. And so now you're buying a taxable, and here's a classic example. A car, when you buy a car for yourself, it's 100% taxable. It just costs you 50% more for that car that you don't see. Number two, it's a liability. It's not an asset. It's going down. And number three is it's going down in value. It's not appreciating. And number four, it's a monthly payment. And that is a killer. Cars are wealth drainers. They hit all four of the negative. Now, there's a lot of products and services that are like that, and most Americans buy those things with their credit card. So not only do they buy bad stuff, 100% taxable, it's a liability, it's depreciating, now they're stuck with paying for it every month. And those four reasons are the reasons most Americans with average incomes are not wealthy 30 years later. They just repeat those purchase patterns, and they stay broke. And that's what happens. So what I did when I learned this is every purchase, I looked at those four categories. So first I started with the home, going into the office, went into the retirement account, went into the associate doctors, then and then of course I extended the associate doctors into multiple offices, and then I took that money and moved it into real estate. And that's how I became a millionaire at age 33, multi-millionaire at age 35. So, and then I pay attention every time I buy something. I'm always figuring out where in those four categories does it fit. That helps me to not buy a lot of stuff. There's a lot of things I don't buy, that I have the impulse and the emotion to buy, but then I don't, because I go, wait a minute, this is a depreciating liability, and it's a regular payment if it goes on a credit card. And that's the other thing. I never have monthly payments. I've never had monthly payments, credit cards, nothing like that. Credit cards were always paid off 100% at the end of every month. I never had. That is such unbelievable negative debt. It just will suck you dry. It'll suck the energy out of you. Causes a lot of problems, and financial problems in marriages too, because people just keep buying crap on the credit card, and then they're forced to make monthly payments on it.